This is the Alternative Investing Advantage podcast from Advanta IRA, where we show you how to explore investments beyond Wall Street and open your eyes to new options for your portfolio. It's time to take control and give yourself the freedom to choose where you invest your money.
Hi, and welcome to another edition of the Alternative Investing Advantage podcast. My name is Alex Perny, and today we are very pleased to welcome Gene Trowbridge, a extremely experienced SEC and securities attorney that is going to be talking about how to go through some of the more intricate ways of investing in private placements with related to commercial real estate. It is a wealth of knowledge with well over 40 years of investing experience. So it's definitely something you're going to want to stick around for. But today on the download, we've actually had some relatively good news, or at least some seemingly good news out of the financial markets on the directions that they're going. So hopefully we will see a slightly better turn than what we've been talking about for the past year. Of course, over the holiday weekend, we had Black Friday, which normally sees about 20 to 30% of the holiday shopping or retail sales happen over this short span of time from the Friday following Thanksgiving till Monday. And Black Friday was wholly a bust with in-store shopping. People are seemingly just not heading to stores. And looking into Monday morning's retail reports, it was pretty bad, with a lot of retailers showing either a still negative balance sheet for the year, or at least just a slightly edging towards a break even. However, this Monday, 11/28, showed almost a doubling of the sentiment for online retail shopping. So while we've seen this certainly edge up in past years, especially with COVID, it has just been an absolute blow the doors off of kind of weekend for retailers, with many seeing almost 40 to 50% of their once more traditional brick and mortar sales now come from solely online shopping. So good news for the retail market. However, most retailers are still well below their projected averages for the year, but at least there is some good news coming out of that, with people seemingly to be opening up to a little bit more of online shopping. But with the fears of inflation and a looming recession still very much on people's minds, retail has been taking quite a hit this year. With a little bit more broader context, we have some better news out of China coming with the easing of some of their COVID restrictions for exports, which is helping to ease some of the supply chain issues. However, the easing of some of these COVID restrictions comes on the heels of some more severe personal lockdown measures, which are being widely condemned by human rights activists as being incredibly severe, which are leading to large-scale protests, which haven't seen this scale since the 1980 Tiananmen Square protests for at least personal freedoms for Chinese citizens. So while the global economy is benefiting from some of the actions of China, its own citizens are certainly seeing a large pushback, and large-scale protests are starting to erupt across the country. So, of course, this will be something to watch, as if there is civil unrest somewhere, that typically has a direct impact on things like exports and the economy as well. Now, with holiday travel season gearing up, unfortunately, we have some not so great news coming out of the oil markets, which of course affect everything from you driving to see your grandmother at Christmas to flying for vacations and everything else, because everything kind of runs on the back of oil. The prices are rising amid the U.S. cutting its stockpile reserve releases and OPEC set to meet in the coming weeks. OPEC meeting is largely seen to be a focus on more production cuts, which is going to lead to direct rise on crude oil costs. So, of course, this will be something to watch. We don't know what OPEC's going to do until they do it. They have a long history of being very secretive about what exactly is going to happen in their meetings until, they actually release their reports. And if any type of past performance is an indicator of future endeavors, we will most likely see them vote to start cutting production costs as a direct measure towards other external factors, as a lot of these countries are being a little bit combative with each other and the global markets in general. It's just kind of what happens when you have different legislative and geopolitical issues kind of factoring into what these countries are going to be doing when it comes to setting oil production rates. So, of course, it'll be something to watch, but it's going to be generally seen as something that's going to start raising oil prices, with the U.S. Starting to ease the release of their strategic reserves that was aimed at kind of just band-aiding over the issue of extremely high oil prices that we saw earlier this year. U.S. equities are edging higher on trading of 1129 as the Fed chair Jerome Powell is set to give talks this week on the Fed's path forward with their continued rate hikes and also the state of the inflationary measures in the United States as well. The interest rate increases have certainly had a dampening effect on the U.S. economy, excuse me, which was the intended effect. But of course, with basically clockwork every 2 months, 75 basis point hikes. Now we're seeing 30-year fixed rate mortgages sitting at almost 7% or higher. So it definitely certainly has had the effect of cooling off housing markets quite a bit, and also futures trading as well. But the general sentiment from a lot of analysts is that Jerome Powell is expected to announce that they're going to be reducing the amount of the rate hikes from 75 basis points to 50, which has a lot of investors cheering. The U.S. futures are certainly looking a lot stronger than they have in the previous part of the year. So again, it's just like with the OPEC meetings, it's going to be something that we're going to have to wait and see on, but it'll definitely be interesting to see what the head of the Fed is going to put out there. I'm especially interested to see what their indicators on the inflationary measures are going to look like. Now, cryptocurrency has certainly been in the market, certainly been in the minds of many in the market, with the huge collapse of trading house FTX led by Sam Bankman-Fried. Now, this has not been an insulary event. There have been enormous ripple effects throughout the entirety of the crypto markets, seeing things like Bitcoin falling to their almost 5-year lows, and a lot of other different cryptocurrency platforms and cryptocurrency companies taking a massive hit as well. One coming out this week, which is very big news, is the cryptocurrency lending platform BlockFi has filed for Chapter 11 bankruptcy protection. Now, BlockFi is a large crypto lending platform, which essentially would allow people to invest in crypto loans where you could stake your crypto, people could borrow it, and you could hedge on being a lender in a space rather than an actual equitable owner. This is very large news, as they had a very large stake and an underpinning in the FTX native token, which, for those of you that aren't familiar, a lot of different cryptocurrency companies, for utilization of liquidity, will either make a token themselves or use something like Tether, which I've talked about in the past, which causes issues if one of these particular companies has a big issue or goes out of business. Then the underlying liquidity standard can either be depegged at being dollar for dollar, or just become valueless, in which case they're going to have a big issue on actually moving assets or creating markets, which is basically what happened with BlockFi. So will be interesting to see once the U.S. Bankruptcy attorneys start getting in there and start to move things around as to what the actual effects of this are going to be, because BlockFi did have a lot of outstanding loans of cryptocurrency to many other cryptocurrency platforms. So with them filing for Chapter 11, it's definitely going to be something to have a very close eye on if it comes to people that are looking to invest in cryptocurrency, or people that are holding their cryptocurrency on other platforms, as this might be a big canary in a coal mine to start reevaluating some of your crypto positions. Now, to come back into a slightly more cheery topic before we move over into the what is, Canadian lending markets for real estate are looking to be a little bit better off, with home sales starting to increase, according to a report recently released by the Royal Bank of Canada, or RBC. However, the rate hikes that the Canadian Central Bank were doing seem to have worked, and in line with the U.S. markets have started to stabilize a little bit. However, the real estate markets in Canada are down 30% year over year. So although we are starting to see some improvement in the areas of things like real estate and interest rates and the like, we still are not out of the woods yet, but at least we're starting to see some stability in these markets. And it's great to see that our neighbors to the north are indeed seeing a bit of stabilization on their end as well. This has been The Download. Today on the what is the Jobs Act? Since we're going to be talking with a seasoned securities attorney, I figured it would be appropriate to define what exactly the big block of legislation that kind of created real estate syndications for the average investor is, and that is the Jobs Act, or the Jumpstart Our Business Startups. The Jumpstart Our Business Startups Act, or Jobs Act, is a piece of U.S. legislation that was signed in law by President Barack Obama in April of 2012 that loosens the regulations instituted by the SEC on small businesses. It lowers reporting and disclosure requirements for companies with less than $1 billion in revenue and allows the advertising of securities offerings. It also allows a greater access to crowdfunding and generally expands the number of companies that can offer stock without going through SEC registration. This is the Jobs Act, and this is the What Is. Hi, and welcome to another edition of the Alternative Investing Advantage podcast. My name is Alex Perny, and today we are pleased to welcome Gene Trowbridge of Trowbridge Law Group, LLP, a law firm specializing in syndication and private security practice areas. So, Gene, thank you very much for being with us today.
Well, you're welcome, Alex. I've been looking forward to this. I'm happy we're doing it today.
Absolutely. So tell us a little bit about yourself. Where'd you go to law school? Did you practice in other areas before you kind of got into this niche of, rather specialized law? And, give us the background on yourself.
All right. So it's a three-part life that I've had. Alex, I came out of college, the University of Minnesota, a long time ago, and with an accounting degree. But I didn't want to be a CPA. I wanted to be a salesman. So I went off to sell commercial real estate, which was a big ticket item back then. One of the biggest ticket items you could sell if you weren't an engineer and couldn't sell room-sized computers and airplanes and all that stuff. And so I did that for a while. And while I was doing that, that was probably 7 or 8 years, I started buying some properties myself. And then, like all good syndicators, I found a property that I couldn't afford to buy by myself. And I went to 3 or 4 friends, and well, actually 3 friends, and the 4 of us bought this property. And here I am, a syndicator. So that started really the second phase of my career, went on for about 15, 16 years, where I was full-time in the syndication business. I was raising money through the broker-dealer community back then. Lucky to get in that marketplace, which is something that wouldn't happen today. And what did I do? I built self-storage.
Okay.
I built self-storage throughout the Southern California area. By that time, I'd moved to California, and I was building self-storage. And when it was done, we had built 32 self-storage facilities, and we built them and got them up to about a 50% absorption. And my strategy was never to be a long-term operator of self-storage. So we sold them to long-term operators, public storage and the like. Well, over time, that market kind of changed. Some of the people we were selling to thought they could build their own projects. So I kind of saw that I might have to pivot on what I was doing. So one day I went home and I will tell you that all the great decisions in life are made around, in my life, are made around the kitchen table. So I went home at lunch and talked to my wife, and I said, I've got about 6 or 7 years of income coming in here without raising another penny. We've got a nice net worth. I think I'm going to do what I always wanted to do. So at 45 years old, I went off to law school. And I went to, there are not a lot of schools that'll take a 45-year-old person into law school. So it's called Western State. And I went to law school and I graduated and I passed the bar. And so I've been doing this now for 30 years, Alex.
Oh, wow.
And never anything other than securities laws. I knew when I went to school, I wasn't going to be a criminal lawyer or a family law lawyer. I was going to be a paper pusher, a securities lawyer, never go to court, never do anything like that. So I've been doing that for 30 years. And my practice is 80% real estate, private placements, Regulation D offerings, which we might talk about in a minute, and maybe some Regulation A offerings. And we've made inroads into the cannabis business, into liquor. A lot of people develop their own IPA beers and then want to raise money and go out and get some bigger equipment in a store and all that. And they do that through crowdfunding. So we've been doing that. So that's where we are now. There's 6 people in my firm. I have a law partner, and then all the other associates that I need to keep our business running.
Awesome. Yeah, we've definitely had a lot of crossing of the things that we operate in. I've one of the cooler things when, although not nearly as long of a career as you, but starting off in my career when here in Florida, craft beer back in 2011, 2012 was starting to really blossom as an industry in the state. I got the first experience of people doing investments and that kind of stuff. And unfortunately, with our regulations, with the federal prohibition on cannabis and all that stuff, we unfortunately had to steer away from being able to hold that kind of stuff in retirement plans. But I'm sure once the federal government changes up, I'm sure in the direction I'm sure they're going to go in the near future, that'll be kind of an interesting industry to see open up to a lot more of investors that we deal with. So it's pretty cool. So you started in commercial real estate, and as an operator, then a syndicator, and then got out of that, and then went to law school and kind of came right back into it, just on a different side. So you've really seen the commercial real estate business from all angles. I mean, that's pretty interesting. I haven't ever talked to someone that's really had that kind of experience in it, whether that is just the amount of time you've done it or just that kind of pivot. Most of the people that I've talked to that have had that amount of time in real estate are pretty much on the single family side. I haven't ever really talked to someone that's had that much experience in commercial real estate. So what decade did you start in commercial real estate and self-storage? When was that?
The 70s, I was a broker. The 80s and the early 90s, I was the syndicator. And then, like I said, 95, I went to law school. I'll tell you, it's funny listening to you. When I was doing my syndications, I was using a couple different legal firms. And when I told them I was going to stop doing the syndications, I was going to go to law school, they all said, stop. We all want to do what you're doing. We don't want to be lawyers anymore. We want to be syndicators. I said, have at it. In my career, man, we're talking about the 78 and 79 was a market crash. The Tax Reform Act of 86 was a crash. 91 was a crash. There were a lot of, and there are a lot of ups and downs, of course, in the economy and cycles. Interesting, though, the securities business has been pretty straightforward. I could say that without exception, I've done more business every year that I've been in business, even through the COVID, even through the last 3 or 4 years, our firm year over year has done more
Yeah, and I would say in that whole timeline, really, as far as the private securities world goes, there really hasn't been too many huge blocks of legislation besides the Jobs Act that have really kind of changed too much in that arena. I mean, you had the stuff in 2008 with Sarbanes-Oxley and stuff, but that's a lot more to do with public securities. So it's kind of interesting that you would say that, just of how little has changed. I mean, obviously markets have changed. I mean, you went through the 80s of seeing interest. I mean, how was it trying to underwrite deals with interest rates in the 80s? Was it any different, or does the numbers change?
Cap rates were a lot higher.
I bet. Yeah, it's
cap rates were a lot higher. And I think that the difficult parts of the market all through my career really are the financing issues. There are several times during my career that there was just no financing at all. So, but we still kept doing syndications. We kept doing syndications with hard money loans, with seller carryback. And for example, when everyone was out there buying properties in 2005 and 2006 and putting 5-year loans on them, and then 2008 came along, there was no way to refinance, and that was a hiccup in the market. But then all the vulture funds came along. So as far as being a syndicator, it's always a market, but I think it's financing. I used to say if the bank was going to lend everyone 100%, we wouldn't need any syndications. But that wasn't the truth. And now that the bank is lending 50%, if everyone's got 10% down, we need 5 investors.
Yeah, exactly. That's a great way to put it. One other thing I would just be curious to know, though, is that did you see, and I think we're kind of coming into it now, and I've seen it a lot because I've dealt a lot in the single family space as well. Would you say that the times that the popularity of things like the more creative financing, the carryback, the owner financing, those other things, do those come at times of higher inflation, or is it inexplicably linked to interest rates? What is the kind of defining factor that you've seen, since you've seen so much in this industry, of what kind of triggers that for people maybe that are listening? And we'll get into what I want to talk about, but I find this fascinating to have someone with this much experience on here. What do you think kind of props up those types of strategies for people that to look at? Because I always tell people, be creative. You don't just have to say, okay, we have traditional financing. If we can't get that, if the cap rates don't make sense, if things aren't working out, then we're dead in the water. There's always a way to make this work. People want to buy and sell real estate. So what would you say to that, of what kind of markers have traditionally pushed those types of strategies?
Well, piggybacking on what I said before, I think it's always the cost of funds and the availability of funds. That changes the structuring that you see out there. It's not inflation. Cap rates go up and down and all that, and no one's really worried about the cost of money until they're refinancing. But the thing that's important to know when you underwrite a property, I think a good lender does this, is they underwrite it now, and they underwrite it for when their loan is scheduled to come due. Let's say I have a 5-year loan. If I'm the lender, I know I don't want to be the only source of refinancing that loan 5 years from now. I want someone else to take that loan. So I'm going to look at what's the projection of the NOI 5 years from now? What's our crystal ball about cap rates? What's our crystal ball about value, and our crystal ball about cost of funds? Will other people be out there to cash out this loan? And if they aren't, I'm not going to make the loan.
Yeah, absolutely. I think that's a really kind of interesting way to put it. I think this is going to segue nicely into kind of what we had discussed about talking about, is that from the investor side of things, I think you can kind of draw a lot of parallels to saying, okay, well, does this deal look good on paper now? Okay, here's my preferred return. I feel comfortable with this syndicator, but you don't just look at, this year or next year. If you have a 5-year loan written into that, most of, I would say the predominant majority of these exit strategies are refi. Granted, some people come in and they just get an offer and they sell. Again, definitely probably more a minority on that. Mainly the strategy is for the refi. Don't look now, look at when that, look at what your strategy is, 5-year, when that comes due. Are you going to be in a sticky situation where all your investment strategy is turned on its head? Would you say that's kind of accurate for the
Absolutely.
too?
I think a good broker, a good syndicator is always looking, or should at least be looking at an exit strategy. Okay. So now I was just on the phone before this call with someone who's done a lot of business, a lot of syndication, and they're telling me that in the next 2 years, they have some of these bridge loans, 3 years plus one coming due. And with the interest rate going from 3 to 7 or whatever it is today, they're going to have trouble. They're going to have trouble refinancing. So they're thinking of capital calls, not for the reason that you think a normal capital call would be to help in times of high vacancy, high expenses. They're just simply looking for capital calls as an additional pay down. So when they have their $5 million loan that they can only refinance for $4 million, they're looking to raise an extra $1 million. So it's extra equity.
Yeah, that makes sense.
In there, and I think I said, yes, I've been through that. I've been through that. But one of the big things that we see today, Alex, is 1031 exchanges. Because disregarding what's happened in the last 6 months, everyone who's bought since 2015 has a lot of equity.
Yeah,
they have a lot of capital gains. So let's exchange into something else. And what I'm finding is those transactions usually end up having to be some sort of a tenant in common transaction, because the equity that they have coming out of their property won't be enough on its own to buy a bigger property, which they have to go into a bigger property. So they'll put together a syndication for the extra $1 million or $2 million. They might have $5 million, but they really need $7 million to get that $25 million property. So we're doing a lot of tenants in common, which is interesting. And this goes into your business. I'm 75 years old. Don't ask me to do an exchange with another 7-year projected hold if my investment in your deal is my IRA.
Yeah, absolutely. It's definitely I could probably talk to you for hours on this stuff. I'm a huge nerd when it comes to the kind of nuts and bolts of this, but let's kind of get down to what I think we discussed, and we can, if we have time at the end, we can branch off again. But awesome information. So what we initially discussed is talking about how people can, vet and, red flags and things to look for when you're coming in as an investor, things to know in, when it comes to commercial real estate and syndications. If you're kind of fresh into this, what are some really good road mapping type things that you can do as an investor to say, okay, one, I understand, what I'm investing in, what are some of the issues that typically are run into by investors in these types of scenarios. And, in general, for someone that is a little bit greener in the space, how to be safe and successful when investing in commercial real estate syndications.
Okay, I've got 4 questions I think an investor should ask. And you're going to find out none of them really have anything to do with the investment. But I think before you get too far into it, you should ask these questions. And for those of you who are listening who are syndicators, I suggest you have an answer for these. Okay?
Absolutely.
The first question is, Alex, I've looked at your deal. It looks pretty good. You've got a minimum investment of $50,000. I got $50,000. I'd love to invest in your deal, Alex. But tell me what happens if something happens to you. And that's a showstopper right there. In fact, our law firm, we will not write any syndication documents where Alex as an individual is the managing member. We have to have continuity. We have to have legal continuity. I've had clients who, in the last 3 years, who died of COVID. What do you do if that client is the only person who can sign loan documents, is the only person who can make decisions for the entity? What do you do? The passive investors don't want to take over. They don't know anything they can't take over. So I think the number one question is continuity. And so in order to solve that, we just suggest in today's market that Alex go out and find someone else, and the two of you at a minimum form an LLC to be the managing member, so we have continuity. In my world, when I was syndicating, I formed an S corporation to be the general partner. We were doing limited partnerships at the time. And then that S corporation, of course, has unlimited life. Okay, you just need to figure out who's the board of directors and who are the shareholders, and that was fine. Limited liability companies can be dissolved by law if the single member is gone.
Yeah.
So you've got some problems there. So don't invest like that.
So what would inherently would be, so to kind of bridge off that, what inherently would be the benefit of having an LLC be a managing partner or a general, or would have, but to having an LLC with multiple partners being a managing member or being a general partner, what inherently would be the difference or the benefit of that versus, let's just say, having two people, just name two managing members? I mean, I guess that would kind of split up they would have to have equitable interest if they're members. I guess I would.
Well, you could have two managing members, but I don't like that, because if you visualize, Alex, the entity that's, no one can see this, but there's an entity that's an LLC that all the investors go into. Okay.
Yeah.
That LLC protects those investors from the outside world. But if, Alex, you step into that LLC just as Alex, and you say, I'm going to be the member, you have no protection from the other investors.
Okay. I got
you. So, no matter what, we've got to protect the managers in some sort of an entity, an S corporation or an LLC, from the other investors. We have to do that.
Gotcha. And would you say that, to kind of further drill down on that, as far as one of the things that you say to look out for, should the investment provider, the managing partner, the general partner, should you pretty much be looking, they say, okay, great, I see this, but should they have some transparency on who the actual shareholders of that entity are?
Absolutely.
Okay.
The whole world of securities law is based on full disclosure. So the private placement memorandum, which part of which is a disclosure document, will name the manager, and then will name the individuals who are in the manager. And in my documents, Exhibit 4, which is the investment summary, the business plan, there's going to be a biography of Alex and whoever the other person is, a little track record, a little biography. Yes, you'd be required to give that. Now, the investors don't need to see, let's say you and I were in a deal as two members of the managing member. They don't need to see our agreement.
Yeah.
They just need to know who we are, who's making decisions. And they don't even need to know how we're splitting whatever we get. But they do need to know that there is continuity. So that's the first question.
Yeah.
The second, go ahead.
I was just going to say, and to that point, so to bring this into perspective, is that if you're beginning investor in this kind of stuff, those are, again, correct me if I'm wrong, that is required disclosure. If you have an entity in a managing position in a private security, that they disclose the interest in that. So if you're an investor, past just seeing the continuity of business, if they don't disclose that, again, big red flag. You can pull a PPM offline and make something look really fancy and official, but these are the kind of things that you need to, again, trust but verify. And if you don't see that, again, huge red flag. Pump the brakes, reevaluate things, move a different direction. But again, making sure that they, they don't just say, oh yes, we have continuity because we have this. You need to have, the other part of that equation in there as well.
That's true. And I think that there's no one looking over the shoulder of that manager entity and making a decision whether they're okay, whether it's done correctly or anything. The investor needs to look at that. The plan administrator is not going to go through that.
Yeah, we don't
make any decision about that. They just need to know who's signing, what's the authority, and is that the authority that's signing the operating agreement and the subscription agreement, be done with it.
Absolutely. All right,
Right.
great. What's the next one you got for us?
The next question is, Alex, have you done this before?
Yep.
So it would be great to say, yeah, I've done 32 things, but every one of us, including myself, when I was asked that question way back when, had to say no, I haven't. But here's my real estate background. So you have to have some real estate background, some credibility to get the first deal done. So when someone asks you the next time, you can say, hell yes, I've done one. But that may be all that it takes. And Alex, in your first deal, I found over the years that the investors generally are known pretty well to the syndicator.
Yeah.
I'm not going to use the term friends and family because that brings up other questions, but there's a pre-existing relationship. They know that Alex is successful in whatever business he's in. Maybe it's a real estate business. And gee, if Alex found some opportunity and he let me be part of that opportunity, I'd like to do that. And then you get your first deal done.
Yeah,
and
absolutely.
I think that's quite important.
Yeah, absolutely. And to the point that you mentioned of friends and family, that is an actual legally defined term when it comes to securities law under Reg D, Reg A, and the Jobs Act, correct? Of an investor.
The legal term is pre-existing.
Okay.
And it doesn't have to be. There's no exception, and that's one of the fallacies. People call me all the time. They say, "Well, I'm just going to do a friends and family deal." I said, I don't care. You're going to do a deal if it's 506B where you have a pre-existing relationship with the people, and I don't care who they are. In fact, you could make an argument, well, that's stupid, Alex, to take family members into your deal.
Yeah, it makes for a really awkward Thanksgiving dinner next week if you have investments in friends and family. That's kind of my favorite term for that.
No, pre-existing and substantive is really the issue.
Okay.
But anyhow, so have you done it before? So that's important. And one of the things I'm seeing today, kind of off to the side, in the last couple of years, multifamily syndication has been very, very strong. There's an imbalance in supply and demand in housing. So we don't have enough housing. So multifamily is good. We've had a lot of people who've lived in apartments who are now going to invest in apartments because they think they understand it more so than a mini storage facility.
Sure.
Okay, so that's all fine. But I've got sponsors who are leaving the multifamily business and heading for, let's say, mobile home parks. Because mobile home parks today's market are generating more cash flow.
Absolutely. I've seen that. I can echo that with what I've been seeing as far as people trying to either break into that market or just the popularity of people actually syndicating and trying to get into mobile home parks just because of the shift in, they were kind of an underappreciated asset class in this space for so long. People like to kind of look down on trailers, which, I mean, there's nothing wrong with it. If that's where you can afford to live, that's where you can afford to live. But those things make money. That's just as green as an apartment building. That's just as green as $1 million home. Those checks cash.
Yeah, it's low income housing.
Yeah,
it really is low income and good housing for seniors and all that. But what I'm concerned about, if I've asked you, have you done this before? And you said, well, I've done 5 multifamily investments and they're all clicking along, but this mobile home park in Temecula, California is really a good deal. Well, wait a minute.
Yeah.
What do you know about mobile homes? I went through a training once through some organization that teaches you how to do mobile homes. I was going to be a speaker, so I thought I'd go to the whole event. And they showed a 3-hour video of a tour through a factory that builds the coaches.
Mm-hmm.
That's not apartment construction. That's totally different. And I kind of think if you're going to buy a mobile home park where you're going to own the coaches, there's an education to that. Now, if it's just the tenants who own their own coaches and you just own the land, maybe that isn't all that important. But if you're actually going to own the coaches, what do you know about construction? I mean, you know about construction when you walk through your apartment building.
Oh yeah,
Yeah,
absolutely.
but what do you know about those coaches? And so, have you done this before? Is the emphasis on the word this is probably good.
Yeah, and I'm pretty well versed in the mobile home space and just the amount of difference in construction. I mean, the nice thing about apartment buildings is that, you might have 150 units and 300 toilets, and you know what? You can buy one toilet to put in every single apartment. You start getting into the mobile home space, and unless you had built a ground up one from the same manufacturer, you might have 30 pads that have, and let's say you own the coaches, you have all these different maintenance issues that you don't have with a traditional apartment complex. Then you have things like common roadways. If you have to pave roads. If you're on septic, you have to deal with huge septic systems and then EPA issues with all that kind of stuff. So it's just a paradigm shift, and I think that echoes very well. You might you go to someone and say, hey, yeah, I've been doing syndications for a long time. Okay, great, that's awesome. What kind of syndications? Just because it's a syndication, it could be self-storage. A big one here in Florida now is car washes. People are syndicating these little car wash things.
Cash flow.
Yeah.
Cash flow. Cash flow.
Yeah.
I have people who go from multifamily to storage because what's attractive is you've got 600 units and only one bathroom.
Yeah. Yeah. You have 600 units and no tenants.
Yeah, no tenants. Yeah. Well, there's always someone who's sleeping in their unit and they're not supposed to. I've got stories about that. But anyhow, that's the second question. So, Alex, the third question is, Alex, are you going to have skin in the game? Now, my feeling of skin in the game has changed over the years. When I was doing syndication, it just simply meant cash.
Mm-hmm.
If I'm asking everyone to put in 50,000, am I going to put in 50,000, or is 25 enough, or what? And that's kind of a marketing issue. The buyer will decide if I have enough skin in the game. But if you really think about it, all the syndicators are signing the mortgage. It might even be a non-recourse mortgage, but there's still carve-outs. And certain types of properties, it's a recourse mortgage. So I think as a syndicator, I should be ready to tell the story that, yes, I do have skin in the game. I'm going to put some money in. I've had a lot of time invested in finding this property to bring it to you, and I'm going to sign on the mortgage.
Yeah. So what do you think about, and this is something I've run into with people, especially with, some syndications where they'll have, let's say, several general partners or managing members. And they kind of have various reasons why they're in there. Some might be, the operator. Another one might be just, the high net worth individual that comes in to sign on those loan documents. They might have someone else that has, let's say, not a cash skin in the game, but they're the one that went out and bird dogged the deal, and then came in, found it, did all the legwork, and actually got the deal to fruition. So what are your thoughts on that, where you start having, quite a few people in the managerial, operational, rung of it, not the passive investor, the actual active investor in that? Is it something that you think is a red flag? Is it commonplace, or is it just something where you need to make sure that, the person that is really running the ship is the one that has all the experience? Maybe you could enlighten us a little bit on that.
Yeah, I think it's a smell test. I think if you've got a bird dog who's found the property, you've got a KP who's strong enough to sign on the loan, and you've got maybe a property manager who can write reports and run the bank and everything. You've got the syndicator, you're fine. But I've seen deals where there's 15 of those people. And the problem is 4 of them are actually involved in the deal, and the other 11 are there because of their money raising capabilities. And I think that's a huge red flag.
Yeah, you don't want to have too many cooks in the kitchen.
Yeah, if all they're going to do is raise money, and I don't want to get started on the securities law application of that, but if all they're going to do is raise money and don't have any material involvement, do you get a good feeling that it's a really big group for continuity and they've done it before? No, you don't. No, you don't.
So so that's kind of interesting to me. I mean, besides just anecdotally of me thinking, okay, just like with any business, if you have, 18 bosses for, 10, 12 investors, that doesn't really make sense. It'd kind of be miserable to get anything done. Besides just kind of, again, the anecdotal kind of obvious reasons, what are some, kind of to dig a little bit deeper, what are some of the issues that arise from that? And have you seen some of those specific use cases you might be able to speak on as well for having just that huge block of people in the active or managerial position?
Well, generally in that situation, the manager LLC, the manager operating agreement identifies the responsible people, the authorized representative, the managing member. They may all be in there just as members, but there's one or two managing members that make the decision. I think and once again, you have to disclose that. If I found 15 people and all of them, were voting, it was going to be a majority vote on what to do, I'd run. We got to have one or two people. And back to, I'm investing because of you, Alex. I'm not investing because Gene Trowbridge, raised a quarter of the money and doesn't really have any involvement. I'm investing in the lead, if you want to use that term. I am investing in you and your experience. So I think that's a good thing. Plus, I think it's a red flag for the securities regulators when they see that many people in there and they know that they don't have a material role in running the project. They know that they're only in there because they brought in money. And then we're running some trouble in the securities laws. So then the last, what do we say? Continuity. Have you done it before? You have skin in the game. So Alex, the last question is, Alex, I'm 75. How do I get my money out? What's the liquidity provision in this deal? And you're going to say that you have professional attorneys that have drafted the document, and in Article 11 and 12, we have the two plans for liquidity, and I'll give you the document. You can read it and we can talk about it. You have to solve that. You have to have an answer for that. Now, so far we haven't talked about what type of property it is, what's the cash flow, what's the anything, but I think those are crucial questions.
Yeah, absolutely. And I think to the point of, those 4 questions that you ask someone is that, the questions kind of lead into it. Have you done it before? No. Okay. Well, then it's kind of irrelevant because, you're stopping there. If you have done it before, okay, great. What do you understand about this? Here's what I understand. And I always encourage clients, use the investment provider to try to help further your research. Hopefully, if they've done it before, they can provide you some information that you can fact check and help bolster your understanding of what you're doing. Hopefully you have a good understanding of the investment anyway. I would not recommend someone that is, never done real estate before to go, okay, great, blindly hand someone their money if you don't understand the first thing about what the investment is. Granted, there's an argument to be made that that's what everyone does in the stock market, but here we are. So yeah, to that point. Now, one thing that I've run into, so I've had kind of similar conversations with a few different syndicators on issues that they're seeing more prevalent and current, with these with syndications. So a few questions I'd like to ask you that we kind of got through your big banner things to ask. Are there things that are changing, or that let's just say maybe the less, and I always like to phrase this as politically correct as possible, the maybe less reputable or just like not as good syndicators are putting in there that are kind of hoodwinking people or maybe a little bit deceptive. One that a syndicator brought to my attention is that they disclose that it is a return of capital and not a return of capital. So that way they get to reduce the returns that they're paying out to their underlying investors. Was one that he was seeing crop up, that people, just that little switch in word can completely derail what your actual projected income is from a particular investment.
Yeah, I write documents where the sponsor says, I want this to be a return of, so that as soon as we get all of the money returned, then we get to the 80-20 split faster.
Mm-hmm.
Okay, that's fine. But you can't call it a return.
Yeah.
It's not a return. It's a distribution equal to 10% of your original investment, because return by definition is a percentage earned on your investment and we're just giving the money back, it's not a return. And so that's the old issue when I taught CCIM courses for 40 years, and we always taught the difference between return on and return of. And there are some reasons, I think, to do that, but you have to be when I write the documents, I have to be very careful that we're not saying, well, it looks like a 15% cash on cash. No, it's a 15% distribution. You won't know what your return is until you get all of your money back. And then the return will be based on new money. Okay. And so you have to spell that out. And that sentence, distributions are to be considered a return on or of your investment. That one word needs to be explained to the investors. And I know that there are people who don't, not that they're being shady, they just don't know the difference. My most prolific client, Alex, does both.
Sure.
He says, we're going to give you an 8% distribution based on your original investment amount, and anything over that each year is going to be a return on.
Gotcha. Yeah. So I think maybe a better way to kind of go back to my original statement is that, like you said, there might be a reason for doing either, and it's not necessarily, a bad reason to do one versus the other. But for the investor side of things, really understanding and kind of going back into understanding what you're investing in, understand what that means for you. If you're looking for that cash on cash return of saying, hey, I'm parking it there and then I'll get my basis out and then I'm making a preferred return of X, and it's return of capital instead of return on capital, well, your whole strategy is shot because of that one word, on to of.
Yeah, it's just like going to the bank. I got $10,000 in the bank and they're going to pay me 10% interest annually. So I walk down to the bank the last day of the year and I pull out my $1,000, 10% return. I go down to the bank and I pull out 12,000. I pull out 12,000. So I do have a 10% return, but I've taken 2% of my money back. So my distribution is 12, but the bank is not paying me 12%.
Well, if you have a bank that's paying you 12% on cash deposits, I will
stay there. Right.
I will do it just about there's a lot of things I would do to know where that's happening.
Yeah.
Right
Well,
now.
that's just an example that's easy for everyone to understand.
Absolutely. And then one thing, that, kind of coming up towards about the end of our time, but I would like to cover and kind of play on your experience in this is, you've seen money get tight, you've seen money get expensive, you've seen money be cheap, you've seen different things go on in the marketplaces. What are some things, at least, that people right now should kind of be, and I hesitate to use the word wary of, but maybe just a little bit concerned if they, what a particular strategy, that a syndicator is doing, if they're baking in a expected refi, or, what a strategy that in these kind of markets, you just need to make sure you understand and really trust your syndicator. Are there things that you have seen work well in the past, or that you've seen things that people might need to be concerned about when they're reading the prospectus and the actual strategy that this particular syndication has?
Well, in today's market, where are we? November of 2022, exit strategy. It's one thing to say, well, we're going to do this, and in 2 to 3 years, we're going to refinance, give you half of your money back, and then continue to hold the property. How do you know? That should be a discussion. What the plan is, how is that feasible? And it should certainly be in the risk section that this may not happen. And because there have been so many 5-year bridge loans, even if it's 5-year 1-1 or 3 years 1-1, that 3-4 years in the life of a rental property comes and goes pretty fast. If it's at the end of 3 years, you have to refinance. At the end of 2, you're starting to look for a loan.
Yeah.
I think one of the things that kind of counteracts that problem is I think there's a lot of room for rent growth. People are getting paid, depending on what type of property you buy, people are getting paid more on their jobs. Because they're getting paid more on their jobs, they can pay more for the rent. Because the rent is going up, even if the cap rate is also going up, we could see a balancing. Cap rate goes up, rent goes up. So my gosh, the property is worth what we paid for it 5 years from now. Okay, that's fine. So then and we started out with a 75% loan. Why can't we get a 75% loan today to refinance it, given the values are the same? Now, we're not going to be able to pay everyone back part of their principal, which might be important if I'm an IRA investor. Once again, I already said we've got an issue if the sponsor always wants to just do 1031 exchanges, and it's a 7-year hold on top of a 7-year hold on top of a 7-year hold, and I'm stuck with my money in my IRA. I think that I would be interested in really delving into the probability that the projection of a refinance will happen.
Okay.
Or then if not, I think we have to look at the liquidity provisions. Okay, now I need to get my money out. You know, one of the things that I know some people do, they invest every penny of their money, their IRA money, into a deal. And when the end of the year comes, it's time for them to take, you know, their $6,000, $7,000, $8,000 mandatory distribution, and there isn't any money in there.
Yeah, and I mean, I'm actually running into this right now with a client with a private security. It's a more traditional private security in a company, not a like syndication or a deal like that. But you know, the workaround for that is, you know, it's through a family office, and they have you know, an attorney that's willing to write a letter of opinion of value, and we're doing an in-kind distribution of the appropriate amount of shares to satisfy the R&D. That's not nearly as easy if you're not investing through a you know, some type of you know, family office that has ready access to an attorney that can do that. It is doable, but it definitely is a headache, especially for the older clients that are in the pre-tax accounts without Roth IRAs. That, you know, you gotta figure that out, and you know, hopefully, you know, you don't necessarily run into something that's you know, no one's willing to write a value on for you.
No, and I think that comes down to something that the sponsor needs, the lead needs to take into consideration. If you're doing a 506B, you're going to have a offering questionnaire that is going to help the sponsor determine if the person is sophisticated to invest in the deal. Do they have an education or investment experience to let you think that they can read the offering memorandum and understand what the risk is? And I have clients who don't want me to ask the investor's age. I said, I think that's a mistake. I think you should know who's investing in your deal, if nothing else, for a heads up on problems that can happen 5 or 6 years ago. If you've got, I mean, we have a deal right now where $3 million was raised as units that are just simply debt. Okay. And the debt is going to pay an interest rate, and in 4 years going to mature.
Okay.
So what if it doesn't mature? Okay. So we have an opportunity to roll that debt one more time. Well, that might be okay, unless now I'm 80.
Yeah.
You know, I should have looked at that before I invested. Okay.
Well, and also, you know, if you have, let's say, a bunch of a pool of significantly older investors, you know, let's say you have 3 of those investors die and they have 5 kids each, you know, you're going through 3 different shareholders with probate, and then you have 15 different shareholders you got to bring in. I could not imagine the nightmare that would be.
Oh, no, that is. And our document says that in that situation, you, as the managing member, would have the right to determine whether they can vote. You can't stop the economic interest from going to wherever it's supposed to go. But you can control who votes.
Yeah.
I literally had a situation where a guy died, and some of the money went to his chauffeur, and some of the money went to his lady friend, not necessarily his wife. And we're not, and some of the money went to, kids were minors, basically. Well, we're not going to let them vote. Okay. They get the money, that's fine, but they're not going to vote.
Mm-hmm.
So hopefully that's in the operating agreement.
Hopefully. Yeah, that I could just I could imagine someone writing documents that, maybe didn't cover some of those provisions, and just what kind of nightmare that would be. And going back to, from the syndicating side, making sure that, you understand who your investor is as well. I know we've pretty much been focusing on the investor side of things, but I'm sure we could have a whole other hours-long conversation of, if you're syndicating this, what do you look out for, and, who you're bringing in to these investments as well. So with that said, again, I could pick your brain for hours on this. I'm so happy that you came on. It's so cool to talk to someone, because I really haven't ever talked to someone in this space that's been doing it for as long as you have, which is just fantastic. So again, Gene, thank you so much for being a guest with us today. If people want to get in touch with you, or they need some legal service in this arena, because I know finding specialized attorneys in this specific space is, they're out there, but they're not nearly as easy as to find a traffic ticket lawyer or a family law provider. So how can they get in touch with you if they want to follow up?
Our website is trowbridgelawgroup.com, and they can go to the website and they can schedule a consultation with me. That's fine. They can call me directly. My direct line is 949-855-8399. That's 949-855-8399. And I do want to plug my YouTube channel, which is Trowbridge Law, which has a number of interesting interviews with successful syndicators and all sorts of snippets of things that my partner and I think are important. And we do a presentation on these items, and it's a good place to get educated.
Absolutely. We're very big on education here at Advanta. We run bi-weekly webinars on all sorts of different topics with great guests. We have this podcast where we like to bring on people. So it's always good to have people that value education. And for someone that's been to college twice, I think you probably put a good amount of stock in educating.
What's funny, Alex, is that's the only time in my life I was a good student.
What, in law school or accounting?
Law school. It was expensive.
Yeah, it
I was 45 years old, and it was eating into my life with my family.
Yeah.
And what if I did all that and I didn't pass the bar?
There you go. Very valid question. All right. Well, again, thank you very much for being with us today, Gene. I greatly appreciate it. I hope everyone found some good snippets from this conversation that you can take out and use to be successful. This is the Alternative Investing Advantage podcast. My name is Alex Perny. Have a great day.
Thank you for tuning in to the Alternative Investing Advantage podcast. Tune in next week for more investing tips and strategies.
Want to hear more episodes of the Alternative Investing Advantage? Search podcast at advantaira.com and subscribe.